I want you to picture a fortress for a second. High stone walls, a deep moat, maybe a drawbridge that actually pulls up.
Okay.
Inside that fortress is a vault where all the gold is kept. It's safe, it's dry. But outside, in the mud and the rain, is where the battles happen.
That's where the risk is.
That's where the arrows are flying. Now, let me ask you a somewhat uncomfortable question. If you are a business owner or an investor in South Africa right now, are you living in the fortress?
Mm-hmm.
Or are you sleeping in the mud with your gold right next to you, just waiting for a lawsuit or a bad audit to come along and take it?
That is a very vivid image to start with, but honestly, it's the reality for most people. They spend 20 years building the gold, the wealth, but they spend almost zero time building the walls.
Exactly. And that's what we're doing today. We're doing a deep dive into this concept of the asset protection fortress. We've gone through a stack of research on capital gains, tax strategies, estate planning, and specifically the work of Limca Sturman, who was a specialist trust consultant.
Right. She wrote, "Shield Your Business Empire."
She did. And look, I know as soon as we say the word trusts, half the people listening probably want to just skip ahead.
Yeah, their eyes glaze over. It sounds like homework, or it sounds like something only, the super wealthy need to worry about.
Right, that it's complicated, expensive, and, frankly, a hassle.
Or worse.
Or that it's a tax trap. That's the big one I hear. Why would I move my money into a structure that gets taxed at 45%?
That is the headline number, yes.
Yeah.
But here is the mission for this deep dive. We are going to debunk that myth. We're going to look at why the South African Trust might actually be the single most effective tool for wealth preservation and tax efficiency available to a regular business owner.
So we're saying this isn't just for billionaires. This is for the person running a decent SME or someone with a growing property portfolio.
Absolutely. In fact, they are the ones who need it the most.
Okay, let's unpack this.
Yes.
Let's start with the fortress concept itself. Why is the typical South African business owner so exposed? I mean, if I have a company, a Peretti Ltd, aren't that protected?
In theory, yes. A company is a separate legal entity. But in practice, not so much. Think about how most people start out. You're the sole director. You're the shareholder.
Right.
You go to the bank for an overdraft or you sign a lease for a new office. What does the bank always ask for?
A personal surety. They want me to sign on the dotted line.
Exactly. They want you on the hook. So you might think your business is separate, but the moment you sign that surety, you've bridged the gap. You have mixed your personal liability with your business liability.
So if the business goes down...
If the business hits a rough patch liquidation, a massive lawsuit, they don't just stop at the company door.
Yeah.
Because you sign that surety, they come for your personal assets.
My house, my car.
Your house, your car, your kid's education fund, it's all fair game.
That is terrifying.
Right.
You work for decades to build something, and one bad deal wipes out everything.
Precisely. And that's where the fortress comes in. The strategy Limca Sturman outlines is all about separating risk from wealth. You need a trust plus company structure.
How is that different from just owning the company myself?
Think of the company as the soldier. It goes out onto the battlefield, it trades, it takes risks, it signs contracts.
It fights the battles.
It fights, but the trust. The trust is the vault inside the castle. The trust owns the shares of the company.
So I don't own the company.
No. You, the individual, own nothing directly. The trust owns the assets.
Control everything, own nothing.
That's the mantra. You control the structure as a trustee, but you don't own the underlying assets in your personal name. So if the soldier gets taken out on the battlefield, if the company goes bust, the creditors can't breach the walls of the trust.
Okay, the protection aspect makes total sense. Build the wall so the arrows can't hit your savings. But I have to push back on the money side.
I was waiting for this.
That 45% flat tax rate, you can be safe in your fortress, but you'll go broke just paying for the wall.
That is the most common objection, and you are right about the raw numbers. If a trust earns 100,000 Rand and just keeps it there, SARS takes 45,000. Flat rate. It's brutal.
See, that sounds like a terrible deal compared to my personal tax rate.
It would be if you used the trust as a bucket, but you're not supposed to use it as a bucket.
You're supposed to use it as a
A pipe.
A pipe. Explain that.
This is the conduit principle. It's the magic sauce of South African trust law. It says that a trust can act as a flow-through vehicle. If the trust makes a profit, say a capital gain from selling a property, and it distributes that profit to a beneficiary in the same tax year.
The same tax year. That's the key condition.
It is the critical condition. If it does that, The tax liability flows through the pipe along with the cash. It doesn't get stuck in the trust. It lands in the hands of the beneficiary.
So the trust makes the money, but the beneficiary pays the tax.
Correct. And why is that a good thing? Because the beneficiary is a human being. Humans have sliding tax scales. They have annual exclusions. They pay a much lower effective capital gains tax rate.
Okay, I need to see the math on this. The source material had a case study, the Richardson family. Can we walk through that?
Let's do it. So the Richardson Trust sells an investment property. They make a clean capital gain of R2 million. Now, scenario A, they don't know what they're doing. They leave the money in the trust.
Okay, so the trust pays the tax. Capital gains inclusion rate for a trust is what, 80%? Taxed at 45%?
Right. So the effective tax rate is 36%. On that R2 million profit, the tax bill is R720,000.
Ouch. That is almost R1,000,000 gone. That hurts.
It's painful. Now, scenario B. The trustees understand the conduit principle. They decide to distribute that R2 million profit to the beneficiaries, let's say the 4 adult children. Each kid gets R500,000.
So now the tax liability moves to the kids.
Yes. And let's assume the kids are average earners. They aren't in the top bracket yet. Their effective capital gains tax is way lower. When you add up the tax bills for all 4 kids, the total comes to roughly R248,000.
Hold on. Scenario A was R720,000. Scenario B is R248,000.
There is a saving of R472,000.
That's nearly R500,000 just for signing a piece of paper that says pay the kids.
Exactly. That is the difference between buying a new car cash or handing that money to SARS. And that is why I say the high tax rate of trusts is a myth. It's only high if you don't know how to use the plumbing.
That is actually mind-blowing. It's not about avoiding tax. It's about legally choosing who pays the tax.
Precisely. It's tax arbitrage. You are moving the tax event to the person with the lowest marginal rate.
Okay, but that relies on having beneficiaries to distribute to.
It does, but that's usually the point of a trust providing for family. And you can get even smarter. The research mentions harvesting annual exclusions.
This sounded like a bit of a hack to me. This is the R40,000 rule.
It is. Every natural person in South Africa gets the first R40,000 of capital gains tax-free every single year.
But a trust gets 0.
A trust gets 0. So it's at a disadvantage, unless it uses the pipe. If a trust has 4 beneficiaries, it can distribute gains so that each one uses their R40,000 exclusion.
So that's R160,000 of pure tax-free profit you can strip out of the trust every year.
Right. Over 10 years, that's R1.6 million of tax-free growth. It's about compounding efficiency. But honestly, while the annual savings are nice, there is a much bigger, darker benefit, the death tax defense.
Yeah, deemed disposal.
This sounds like the accounting version of a horror movie.
It is a horror movie for your estate. Here is the reality. When you die, SARS treats it as if you sold every single thing you own the day before you died.
Everything. Your shares, your business.
Everything. Even though your family isn't actually selling it, death triggers a massive capital gains event. If you built a business worth R50 million, your estate suddenly owes SARS millions in taxes.
And if the family doesn't have the cash?
Then they have to sell the business. They have to hold a fire sale just to pay the taxes on the business they just inherited.
That's how family empires collapse.
Exactly. But if the assets are in a trust,
Then what?
a trust never dies.
A trust never dies. That's profound. It's the ultimate continuity. If the business is owned by the trust and you pass away, the trust just keeps going. The owner, the legal entity of the trust, is alive and well. There is no deemed disposal, no tax event.
So the R50 million business stays a R50 million business, 0 tax triggered.
0. The Thomas family example in the notes shows they saved their heirs about R9 million in immediate taxes just by having the shares in a trust. That is generational wealth.
Okay, I'm sold on the concept. It protects the assets, it saves tax if you use the pipe correctly, and it stops SARS from looting the estate. But, and there has to be but this can't be as simple as just open a trust and win.
Oh, definitely not. And this is where we have to issue a serious warning. If you try to DIY this or you just download a trust deed off the internet, you will get burned. There are gotchas all over the place.
Let's talk about the anti-avoidance rules. SARS isn't stupid.
SARS is very smart. The biggest trap is the attribution rules.
Is this where I try to give money to my wife to lower my tax?
Basically, if you donate money to a trust and the trust invests it and then pays the profit to your spouse or your minor children, SARS looks right through the trust. They attribute that income back to you.
So I end up paying the tax anyway.
You do. You can't use a trust to simply split income with your spouse or minor kids if you were the one who funded it. It works best with adult children or if the trust has built up its own capital over time.
Okay, what about this Section 7C that gets thrown around a lot? The interest-free loan trap.
Right. In the olden days, you'd lend $10 million to your trust interest-free. The trust would invest it, make a profit, and you'd pay no tax on the interest you didn't charge. It was a massive loophole.
And SARS closed it.
Firmly. Now, if you lend money to a trust interest-free, the interest you should have charged is treated as a donation, and you pay 20% donations tax on that phantom interest every year.
Wait, so does that kill the strategy? Is it even worth it then?
You have to run the math. For high-growth assets, it can still be absolutely worth it. The eventual capital gain saving can easily outweigh the annual donation tax cost. It's a cost-benefit analysis.
Okay, so you pay a little bit now to save a lot later.
Exactly, but you have to calculate it. And then there is the one rule you absolutely cannot break.
Go on.
The primary residence rule. Do not put your primary home into a trust.
But I thought we wanted to protect everything. If I get sued, I want my house to be safe.
I know, and that is the instinct. But if you own your home personally, the first $2 million of profit when you sell it is tax-free. That's the primary residence exclusion.
And trusts don't get that.
Trusts do not get that. You are voluntarily giving up a $2 million tax break. It's a classic rookie error.
This is getting complicated. We've got attribution rules, Section 7C, primary residence exclusions. It feels like walking through a minefield.
Which brings us to the role of the guide. We mentioned Lemke Sturman earlier. Her entire business model is based on the fact that a trust is not a set-and-forget document. It's a living thing.
It needs maintenance.
Serious maintenance. Remember the conduit principle, the magic pipe.
Yes, distributing the profit in the same year.
Well, here is the kicker. If you don't hold the trustee meeting and sign the resolution to distribute that money before the end of February, the tax year end, the pipe closes?
You can't backdate it.
Absolutely not. If you miss the date, the trust pays the full 45%. End of story. SARS is militant about this.
So you need someone who actually nags you to sign the papers.
You need a fortress audit. You need an independent trustee.
That's a legal requirement too, right? I can't just be the trustee of my own trust.
You can be a trustee, but you can't be the only one. The courts look at that and say, this is a sham. You're just treating the trust like your left pocket.
And then the whole fortress falls down.
Exactly. You need an independent outsider, a professional like Lemke, to prove there is a separation of control. It prevents creditors from piercing the veil.
So let's bring this all together. It seems like the strategy is build the walls to protect the assets, use the pipe to manage the tax, and don't try to be your own lawyer.
That's a perfect summary. It's about defense and efficiency. Defense against the unknown lawsuits, audits, and efficiency in ensuring your family keeps the wealth you worked for.
For the listener who is realizing they are currently standing in the mud, maybe they have a company but no trust, or a trust they haven't looked at in 10 years, what is the move?
You need a diagnostic. You need to see if your current structure is actually a fortress or just a pile of bricks. Lemke Sturman is the expert we've profiled today. You can find her at www.lemkesturman.com.
And her book is a good starting point.
Her book, Shield Your Business Empire, is great. But I'll leave you with one final thought on timing, because this is the most important part. People say, I'll set up a trust when I sell the business.
But that's the most expensive time to do it.
It's too late. The cost of moving assets into a trust is triggered by their value. The best time to build the fortress was yesterday, when your business was small and the assets were cheaper to transfer.
And the second best time.
The second best time is today. Don't wait until you are signing the sale agreement to think about the tax bill.
Build the fortress now.
Ah.
I think that's the message. Don't wait for the rain. Thanks for taking us through this today.
A pleasure.
And to our listener, hopefully you can sleep a little better tonight. We'll see you in the next one.